On April 7, at exactly 5:32 p.m., Donald Trump opened Truth Social and hit post. The message was simple. A ceasefire had been reached with Iran. Within minutes, the financial world had its explanation. The war is ending. Oil prices are about to fall. Stocks are finally getting some relief. And the next morning, that's exactly what it looked like. The S&P 500 surged 2.5%. The Nasdaq climbed nearly 3%. The Dow Jones exploded more than 1,300 points, its biggest one-day gain in almost a year. More than 400 stocks in the S&P finished in the green. Just a few weeks later, the market was back at record highs. To most people, the story seemed obvious. The threat of a wider war had faded. Investors breathed a sigh of relief. Stocks rallied. Case closed. Except, none of that was actually true. Because while Wall Street was celebrating, the ceasefire was already beginning to fall apart. Ships were still avoiding the Strait of Hormuz. Military tensions hadn't disappeared. The geopolitical risk hadn't magically vanished overnight. So here's the question nobody was asking. If the war wasn't really over, why were stocks acting like it was? Because what happened on April 8 wasn't a relief rally. It was something far stranger. Something far more mechanical. And once you understand it, you'll never look at market headlines the same way. To understand what really happened on April 8, you first have to understand what Wall Street looked like going into it. Because this story didn't begin with the ceasefire. It began weeks earlier. On February 28, the United States and Israel launched joint airstrikes on Iran. Iran responded by shutting down the Strait of Hormuz, the world's most important oil shipping route. Almost overnight, markets began to unravel. Over the next 5 weeks, the S&P 500 fell nearly 9%. It was the market's worst losing streak in almost 4 years. If you looked at your portfolio, it probably felt ugly. But underneath the surface, something much bigger was happening. Wall Street wasn't just getting nervous. It was panicking. Hedge funds weren't slowly reducing risk. They were dumping it at the fastest pace in 13 years. And that's not speculation. We know this because Goldman Sachs was watching it happen in real time. Goldman runs one of the largest prime brokerage businesses on Wall Street. Think of it as mission control for hedge funds. They can see what many of the biggest funds are buying, what they're selling, and, most importantly, how much leverage they're using. According to Goldman's own data, hedge fund selling in North America during the first quarter reached its highest level since April 2020. At the same time, gross leverage climbed above 300%, sitting near record highs. That means hedge funds weren't just making bets. On March 19, commodity analyst Rory Johnston gave one of the most alarming interviews of the year. His message was simple. If the Strait of Hormuz stayed closed, the global economy had a serious problem. He estimated the world could lose roughly 15 million barrels of oil per day. To put that into perspective, that would be the largest oil supply disruption in modern history. Brent crude could surge toward $250 to $300 per barrel. Inflation would explode. And, in his words, we wouldn't just be talking about a recession anymore. We'd be talking about something much worse. A global economic shock. That was the mood on Wall Street going into April. Fear. Extreme pessimism. And a market position for disaster. Then, at exactly 5:32 p.m. on April 7, Donald Trump announced a ceasefire. Wall Street finally got the headline it had been waiting for. Or at least, that's what everyone thought. Then, at exactly 5:32 p.m. on April 7, Donald Trump announced a ceasefire with Iran. For Wall Street, it was the headline everyone had been waiting for. One sentence. One post. And suddenly, the entire narrative changed. The war was ending. Oil prices were supposed to fall. The worst-case scenario was supposedly off the table. When the markets opened the next morning, it looked like someone had flipped a switch. The S&P 500 surged 2.5%. The Nasdaq climbed nearly 3%. The Dow Jones gained more than 1,300 points. More than 400 companies in the S&P finished higher. It wasn't just stocks. Brent crude plunged roughly 13.5%. WTI crude fell more than 16%. The largest one-day decline since April 2020. Financial media had its explanation almost instantly. The market is celebrating peace. The ceasefire removed uncertainty. Investors are breathing a sigh of relief. It sounded reasonable. It made for a great headline. There was just one problem. Reality didn't match the story. Because while markets were behaving as if the conflict had ended, the conflict itself hadn't. According to maritime intelligence firm Windward, which uses satellite imagery, GPS tracking, and AI to monitor global shipping, traffic through the Strait of Hormuz barely recovered. By midday, only 5 outbound carriers had been detected moving through the strait. Before the conflict, roughly 130 ships crossed every single day. That's a decline of nearly 96%. Think about what that means. If global shipping was still disrupted, if military tensions were still escalating, if the ceasefire was already beginning to unravel, then why were stocks acting like everything was back to normal? Because maybe the rally had nothing to do with peace at all. Maybe the headlines weren't explaining what happened. Maybe they were chasing it. The real story wasn't happening on television. It was happening inside hedge funds. Inside algorithmic trading models. Inside the options market. 3 separate forces. All about to collide at exactly the same time. And the first domino was something every trader fears. A short squeeze. Before we can understand why that happened, we need to understand how short selling actually works.